There's no doubt in my mind there's going to be more bank failures.
Or at least dip below their minimum capital requirement.
There will be bank failures, but this is not the big banks.
The FDIC report states that unrealized losses on available for sale and held to maturity securities increased by $39 billion, reaching a total of $57 billion in the first quarter alone. The rise in mortgage rates during this period led to higher unrealized losses on residential mortgage-backed securities, which contributed to the overall increase. Notably, this marks the 9th consecutive quarter of unusually high unrealized losses since the Federal Reserve started raising interest rates in the first quarter of 2022. I want to emphasize that this is the 9th straight quarter, not month, but quarter of unusually high unrealized losses. Unrealized losses are essentially losses that haven't been realized yet. They're just sitting on the books, and banks are waiting for better times so they don't have to show those losses on their income statements. So why is this significant, you may ask? Well, it's bad news for several reasons. First of all, this means that banks are likely to face liquidity issues moving forward. This means they might struggle to have enough available cash to meet short-term obligations, such as deposit withdrawals, which is terrible news for everyone. Secondly, banks primarily make money through lending, but liquidity issues prevent them from lending effectively. Regulators require banks to set aside provisions for bad loans known as reserves. These reserves are calculated based on a specific formula that factors in current delinquency rates, associated risks, forecasts, and so on. We should expect to see bank reserves increase when banks report their second quarter financial results in July. Having adequate loan reserves is crucial because it ensures that banks can leverage these reserves against losses in the event of unforeseen events, such as a bank run. However, that's not what we're seeing right now. Unfortunately, as economic conditions deteriorate, banks currently have smaller reserves on their books than they did even a year ago. International Banker reports that the Federal Deposit Insurance Corporation, FDIC, revealed that U.S. banks currently hold $1.40 in reserves for every dollar of delinquent commercial real estate loans. This is a significant decrease from the $2.20 held in reserves for every dollar of delinquent loans recorded a year ago, marking the lowest level in over 7 years. If that's not a recipe for disaster, I don't know what is. Additionally, the FDIC has reported a decline in loan growth, as I mentioned earlier. The report states that the industry's annual growth rate of 1.7% is the slowest since the third quarter of 2021 and has been steadily declining over the past year. So there you have it. Tighter lending standards, a less optimistic forecast for the future, and consumers already burdened with household debt to the point where they may not qualify for new loans. These factors have resulted in the slowest loan growth rate since 2021. This is crucial because lending is the primary way for banks to generate revenue. The FDIC is beginning to acknowledge that commercial real estate loans are struggling, which is going to become a significant issue. This is a huge red flag that I urge you to pay attention to. The FDIC reports that asset quality metrics were generally favorable. I have to pause here to say that I have no idea what generally favorable actually means. It's just a sugar-coated way of saying things aren't really going well. Moving on, I'd like to highlight the second half of the sentence. Generally favorable with the exception of material deterioration. This means there is significant deterioration in commercial real estate and credit card portfolios. One key point to highlight is that the longer interest rates remain elevated, given that inflation isn't going away. This will have a significant impact on the financial sector, particularly on the banking industry. According to International Banker, the average reserves of major banks like JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, and Morgan Stanley have fallen from $1.6 to only $0.90 for every dollar of commercial real estate debt that is at least 30 days delinquent. This is alarming. It means that delinquent commercial real estate loans, which have tripled to $9.3 billion for these 6 major U.S. banks over the past year, now exceed the reserves held by these banks to cover them. They don't have enough reserves to cover these bad loans, which could become a huge problem if those loans end up in default. In late March, S&P Global warned that there is now a high likelihood of regional lenders experiencing asset quality erosion due to stresses related to commercial real estate loans. An increase in the number of so-called modified loans where a lender makes concessions to help the borrower would also lead to a decline in asset quality. This is very bad news for the banking industry, particularly for mid-sized regional lenders. These deteriorations indicate more stresses and potential failures in the coming months and years, potentially plunging the U.S. banking sector into another crisis. Should interest rates remain elevated and property values fail to recover, loan default rates might reach or even surpass those seen during the 2007 to 2009 global financial crisis. Depending on the magnitude of these defaults, the resulting stress on the banking sector could ultimately trigger a wave of failures among lenders. Now, if you like this video, check out this next video right here.